monetary policy. In a modern economy, money is the universal medium of exchange. It enables the fluidity of economic exchanges, without which a modern economy is impossible. In simple English, this means that you can buy virtually anything with money, and almost anything that's not illegal can be sold using money. In the absence of money, you would have to rely on barter. You would have to exchange goods for goods, or services for services, or goods for services. But money allows you to purchase what you want when you want it. When you use money, you can rely on the idea that the seller is going to accept your money in exchange for goods or services. And if you become a seller, you will expect that the buyer will pay you using money for your goods or services. So if you have money, you have fluid, very rapid, very easy economic exchanges. Without money, you don't have that. Therefore, you should understand that money serves this huge economic function. And the purpose of money, the best definition of money, is to describe its function or purpose. Money can take many forms, and it does not matter whether it's paper money or coin or virtual money, electronic money, checks. Does not matter. What matters is the function that it serves. In terms of its definition, the best definition is the functional definition. Money is the universal medium of exchange. Money is also the finder or marker of economic value. How do you know what goods and services cost? The cost is measured in money. Without money, you have no marker. What do you need to pay for a gallon of milk? You're going to measure that in money. You can say, okay, it's $3. But if you didn't have money, what would you have to pay for a gallon of milk? 1 raw chicken? 2 pastries? What? You see, so without money, modern economy is impossible. Money also simplifies and depersonalizes social relations, replacing a system of obligations with a simpler system of exchange. So if in the past you needed to depend on your tribe or your clan for physical protection, for basic necessities like food and drink, today you pay. So how do you get physical protection from the police? Well, you pay your taxes. How do you get your food or drink? You go to the supermarket and you use your money in whatever form. It might be a credit card, it might be cash, it might be check, in whatever form, and you buy your food and drink. And so as economies mature and become more complex, money becomes more necessary, and as there is more money, it can buy more goods and services, replacing the need to rely on your kinfolk for those goods and services. So money makes exchange less personal, and therefore social ties less predictable and less strong. Money also has to be carefully managed. Maintaining the proper supply of money in circulation is vital. Any failure to do so can result into catastrophic disruption. Just as, for example, too much sugar in your bloodstream can eventually lead to an onset of type 2 diabetes, and not enough sugar in your system can result in a loss of consciousness, as the brain needs sugar in order to function. So does the economy need just the right amount of money circulating? If you don't have that, you're going to have trouble. In the United States, it is the Federal Reserve System, or the central bank, that manages the proper supply of money in circulation. The Federal Reserve, or simply the Fed for short, is a system. It is best to visualize it not as a single building, not as a single entity, but rather as a network of banks and organizations. So how do we define the Federal Reserve? I think to begin, we should define it functionally. The Fed is a bank for private banks and for the federal government. At the same time, the Fed is also a regulatory agency. But today, we will only talk in terms of the Fed being a bank for private banks and for the federal government, and we see how using that function it tries to maintain the proper supply of money in circulation. The United States is divided into 12 districts, and there is a Federal Reserve branch in every one. So already we see that there are 12 Fed branches across the United States. The Fed has a dual mission. First, to strive for full employment, and second, to minimize inflation. There's an employment-inflation trade-off, at least based on the conventional economic theory. And the trade-off says that very low unemployment usually leads to elevated rates of inflation because people and businesses spend more money. Now, why should this be so? Because when a lot of people are working, a lot of money is being made, and the more money people have, the more they usually spend. And the same for businesses. As unemployment is low and businesses are operating at full capacity, they can expand. So they continue to expand, more money is being generated. And of course, in contrast, when unemployment is relatively high, inflation is relatively low. The Federal Reserve considers 5.2 to 6% unemployment rates to be the normal long-run rate of unemployment. This is the unemployment rate that can be achieved without excessive inflation. Most economists estimate full employment somewhere between 5 and 5.5%. So that level and slightly less can be considered frictional unemployment. Frictional unemployment is what happens when people are between jobs. Now, if the supply of money is not properly regulated, it can lead to hyperinflation when the government simply prints too much money. You can see in this video photos from what happened in Germany between 1919 and early 1924. In those years, the German government printed too much money, partly to pay reparations to the victorious World War I powers such as France. Germany was forced to accept guilt for starting World War I, and it was punished by heavy reparations. In order to pay them, and at the same time to diminish the real value of the reparations that it was paying, the German government had printed a lot of money. And in some cases, you needed a wheelbarrow of money to buy a loaf of bread. Eventually, the situation became so ridiculous that people just threw their money away, and you can see a janitor sweeping away currency. You can see a woman using stacks of money to try to heat her home, putting that money into a chimney, and you can see kids playing with bricks made out of money. And of course, if this continues, people lose faith in their currency, everything becomes very expensive. The reason why printing money to get out of problems does not work is because everyone anticipates that things will become only more expensive, right? Because if businesses are selling bread for X dollars per loaf of bread, and they know that the government will print money and everyone at work will be making a lot of money, well, businesses will raise their prices. And as they do, government then can try to print more money and businesses will raise even more money. And then very soon inflation will simply become a psychologically reinforced spiraling upward of prices. So prices will go higher and higher and higher. And that's exactly what happened in Germany between 1919 and 1924. Now, you also don't want to have too little money in circulation, because if you strangulate the money supply, then there's not enough of it for businesses to borrow, to expand. There's not enough for consumers to spend, and businesses contract. So you want to have balance between unemployment and inflation. You want to have unemployment as low as reasonably possible, and you also want to have inflation that is as low as reasonably possible. So how can the Federal Reserve System change the supply of money in circulation? First, it can order the Treasury Department to create more money, literally to print more money. The Fed doesn't print money, but the Treasury Department does that if the Fed requests. Second, the Federal Reserve can change the discount rate. That is the rate at which private banks borrow from the Federal Reserve. The lower the discount rate, and that's a target rate, it's actually a rate that has a range. So for example, today, if it's 2016, the rate is currently 0.25% to 0.5%. That is to say, a quarter to a half percent. And banks borrow from the Federal Reserve, and then they lend this money to you. And let's say you have a credit card that charges you 10%. So the bank borrowed for 0.25 to 0.5%, and it then lent that money to you for 10%. The bank makes a profit. The Fed funds rate is a rate at which private banks borrow money from each other, usually overnight, in order to cover their Fed reserve requirement. You see, the major banks are required to be members of the Fed, and they have an account with the Fed, and that account has to have a certain liquidity in it. So the banks are required to maintain a certain percentage of their total assets on account with the Federal Reserve. And when they fall short, and they can fall short because, let's say, they lend too much money, they're always tempted to lend because it's the bank's job to lend money. So if a private bank lends too much money and it needs to cover the reserve requirement, it simply borrows from another bank to do that. So the Fed can also lower the Fed funds rate. When it lowers the Fed funds rate, the banks will feel freer to lend more money, because if they fall short of the reserve requirement, they know that they can always borrow from another bank and the rate will be low. The same is true with the discount rate. The lower the discount rate, the more willing banks will be to borrow from the Federal Reserve. And the more they borrow from the Federal Reserve, the more they will lend to consumers. Consumers will spend, pumping life into the economy, making the economy grow. Now, the Fed can also change the reserve requirement. In the United States, this does not happen very often, but the Fed can do so. So changing the reserve requirement simply means changing the percentage of their assets that banks have to maintain on account with the Federal Reserve. So if you increase the reserve requirement, you take that money off the table as far as the amount of money that private banks can lend out to consumers and businesses. Higher reserve requirement means less money in circulation, and conversely, lower reserve requirement means banks will lend out more. There will be more money in circulation. Finally, the Federal Reserve can buy or sell government bonds from private banks that hold them. So when the United States government sells its bonds, and that is to say, when it borrows money, it borrows sometimes from private banks. And so private banks, let's say Bank of America or Chase or Wells Fargo, they're holding these government bonds. When the Federal Reserve buys these bonds from private banks get what in exchange? In exchange, they get money, they get liquidity, and then they can use that money to lend to consumers and businesses. So when the Federal Reserve buys bonds from private banks, that's known as quantitative easing. And then the Federal Reserve can sell those back to private banks. In most cases, the banks have to take those bonds back. What's going to happen is the Federal Reserve will simply credit back the bonds and will automatically take the money equivalent to the purchase of those bonds, the sale price of those bonds from the banks. So buying bonds from the banks, that's known as quantitative easing. Who actually makes monetary policy? Well, almost all of the monetary policy the Federal Reserve makes through its Federal Open Market Committee operations, FOMC for short, And monetary policy, that's the monetary policy making body of the Federal Reserve System. It has 12 members. The 7 members of the Board of Governors, including the chairperson. As I speak now, Janet Yellen is the chairperson of the Federal Reserve. So you have all 7 board members, plus presidents of 5 out of 12 reserve banks. Four of these presidents rotate. Remember, there are 12 banks, 12 branches across the country. 4 of them rotate. The president of New York branch of the Federal Reserve doesn't rotate. He's always there. Maybe because New York is so important financially, Wall Street is there. It's the economic center of the Western world. And so president of New York's branch of the Federal Reserve is always a member, along with 7 board members of governors, plus 4 rotating bank presidents of the other 11 reserve banks. And they meet on a regular basis. 8 meetings per year are scheduled. There can be emergency meetings, although they are rare. So there's a meeting about once every 6 weeks or so. The committee may also hold unscheduled meetings, as I said. The FOMC issues a policy statement after each regular meeting, and it summarizes the committee's economic outlook and the policy decision of the meeting. 4 times per year, the chairman holds a press briefing after the FOMC meeting to present the FOMC's current economic projections and to provide additional context for the FOMC policy decisions. And a full set of minutes for each FOMC meeting is published 3 weeks after the conclusion of each regular meeting, and complete transcript of FOMC meetings are published 5 years after the meeting. So there's nothing particularly opaque about about monetary policy. And remember that the chairperson of the Board of Governors is also required to testify before Congress periodically. So the policy, once demystified, I think becomes easily understood. And in conclusion, I will just say that since 1982, the Federal Reserve has been extremely successful in achieving its objectives, particularly in keeping inflation at bay. After very high inflation rates of the late 1970s and early 1980s, inflation became a great fear in the United States, and this fear was reinforced by extremely high rates of inflation in the 1980s in many Latin American countries like Argentina and Mexico, and in many other places in the world, for example, in Israel. And of course, the memory of the German hyperinflation continues to haunt, to some extent, monetary policymakers. But what's remarkable is that using complex mathematical formulas, the Federal Reserve has been extremely successful in keeping inflation at bay. After 1983, inflation rate ranged in most years between 1.5% and 4%. I mean, it's been really remarkable how low inflation has been. And at the same time, in the United States, unemployment rate has remained fairly low, except in those isolated years when it was high as a result of a recession. For example, in 1990-91, unemployment rate was elevated, and then in 2008, 2009, 2010. But for the rest of the time, between 1983 and 2017, unemployment rate has been low. So the Federal Reserve actually has been quite successful in carrying out its mission, despite the criticisms that it receives, and it receives a lot of them in some popular news outlets. I think people just tend to misunderstand what the Fed does, and ignorance often leads to fear. All in all, our central bank, our Federal Reserve System, has been incredibly successful in accomplishing its mission, particularly so after 1982. Thanks.